Welcome to Kaizen Time, part of the Blood, Sweat, and Business podcast, where we provide constant improvement to businesses through timely, actionable financial solutions. Do you want answers to your financial questions? Email us at bsp@kaizencpas.com. I'm your host, Mark Valesky. Now let's get started. Welcome to another episode of Kaizen Time. I'm joined by Henry Jorn, Director of Tax and Accounting. Henry, would you say you're in optimal health?
No.
Who's someone that you would say is in optimum health?
John Chiappetta.
John Chiappetta. We are sharing this with John Chiappetta. If you guys haven't seen John Chiappetta, I'm going to put a picture of him on the screen. We just saw him this week. He is in quite good health. Now, here's the question for you, Henry. What is the difference between why your health is the way it is compared to John Chiappetta's health?
Because he has discipline.
Okay.
So, he's going to the gym on a regular basis. He's working out. Mm-hmm. I am going to the gym on a when I feel like it basis.
Okay, so we already know where this is and kind of where we're going. We are going to be really digging into strong versus weak business health, okay? But it's really not that different between someone's physical health who goes to the gym versus anyone who doesn't go to the gym. I'm not trying to knock on people who go to the gym and don't. That's nothing like it. But the rules are kind of the same. So, Henry, you've seen a lot of businesses, some that are failing, some that are doing well.
Correct.
And some of them look almost exactly the same. And why is that? And don't tell me it's just because of price, because we know that's not the case.
No, absolutely not.
Tell me a few of these key metrics. Tell me some processes. Give me kind of just like a list of stuff, and we'll break them all down.
I mean, just strictly speaking numbers, when I take on a new client, look at their numbers, et cetera, the first thing I'll poke at is the balance sheet. We take a look at equity. If equity is negative, and I know this is going to sound like it's super obvious, that is a big problem. You should not have negative equity in your company. I mean, maybe when you first start out and your first couple of years are losses, but you get, a few years into your business, if you're seeing you have negative equity, it's probably time to take a pretty healthy look at, like, what are you doing?
And we've discussed this before, like, be honest with yourself, right? Because the longer you drag this thing out, the worse it is going to be for you, right?
The one thing that, just going off of this, because I've had some actual direct experiences where this was an issue. When you're in that scenario, right, and you own a business, you enjoy your business, you want your employees to have a, good lives as well. But you're running it dry. Like, equity is kind of like your pool of money. That's your reserves, et cetera, what you've made over time. But if you're pulling all the money out of your business to the point where it's negative, and essentially your business loans are funding your personal life through equity, and, every week you're scared to make payroll and all those sorts of things, you are failing in your responsibility to your employees, because when you become a business owner and you hire employees, you have a responsibility to them to, make sure that you manage the health of the organization, to make sure that they can get a paycheck every 2 weeks. They can feed their families. Like, there's a huge downstream impact on this. Ultimately, like, it also impacts things like, can you get loans, et cetera, loans. Are you paying capital gains on your taxes because you're taking out more money than the business is earning? All these things impact your business, and it shows a high degree of, failure to be disciplined, right? Like, your mantra when you own a business should be the health of the business comes first. business owner comes after that. I can support, like when you game the numbers, right? Like, so if you're a business owner and you work with your tax guy and you pull out as much of the earnings from the business as you can, just to take advantage of the tax advantages of that, particularly like as an S corp owner, but that you still hold that money somewhere that, like, if things hit the fan, you're able to put it back in and keep your business going. That you have the discipline to do that and not, go buy a cigarette boat or, that Porsche that you dreamed of when you were 5 years old.
What I'm hearing a lot so far is the word discipline, right?
Correct.
Let's really dig into that, because the difference between a disciplined person, we'll go right back to the gym. You know who's disciplined because they show up every day,
Yep.
right? And it's not hard. It's not even that fun sometimes, but it's got to be done.
Sure.
So what does a disciplined business look like compared to not? And let's not just talk about the, hey, like shows up every day, hey, sends a check every day. What's kind of the stuff that really sets them apart?
The first things that you do is you have documented processes. How does your business operate, right? Like we'll say a tech, for example, comes in. Does he know every day the first thing that he's supposed to do when he comes in the door? He should. Mm-hmm. And if he doesn't, he should have a place to go that he could find out what he should be doing. And I know that's a very extreme example of what we're talking about, but some of those simple, like blocking and tackling things that you tend to overlook sometimes, you need to make sure those are in place and that you are revisiting them on a regular basis, just like they do in sports, right? You hear it on sportscasts and whatnot. Hey, like, what do we do in the summers? We go back, practice the fundamentals of what you do. Continuously doing that and reinforcing those fundamentals is paramount to running a successful business, especially as we kind of keep going into the continuous path of automation, and now we're talking about AI picking up a lot of tasks and whatnot. You still need to know you and your people still need to know what goes on behind the scenes, or have some idea of it anyways. Otherwise, we're, walking into T2, right? Which is Terminator for those of us that are the younger generation.
Yeah.
Get a monthly P&L. Like, we talk about this on a ton of podcasts. Look at your monthly P&L. Look at your monthly balance sheet. If you have a CPA, CFO, accountant, accounting manager, finance professional, or whatever other type of person that you work with to manage your finances, if you don't understand what you're looking at, ask them questions. Like, we're all happy to answer those questions for you.
Well, and especially if you are, investing in an accountant, right? You go into a CPA, they don't want you to fail. They want
Correct.
you to absolutely succeed, because if your business fails, well, then they just lost a client, right?
Correct.
So understanding those numbers is important. Yes. But not only that, understanding how to adjust those numbers or, make changes. Again, we'll talk about efficiency. Hey, having your employees understand, hey, doing this task, or this is a number, and having a conversation with that number. Henry, I need you to make 20 widgets this week.
Sure.
And look, see, he agreed. Now we're on the same wavelength. So next week, when he doesn't produce his 20 widgets, I can say, hey, what's going on? We agreed on that.
I failed.
You failed. Yes.
Yeah, and that part is a little bit of like setting goals and whatnot, which generally is also a part of, creating discipline, right? If you don't have any goals to shoot for, what are you what are you doing every day when you come in? What are you working towards?
Well, as anyone who's listened to this podcast for a reasonable amount of time will say, I've said this before. You don't get in your car every day and say, I don't know where I'm going.
Absolutely.
You have a goal when you get in your car. You have a goal when you are planning what your business is going to do for the year. Okay. You may not hit it, but at least you had a goal that you were aiming for.
Sure.
I mean, we love to say, our businesses grew by 20% this year. Okay. You may not hit it, but if you didn't have a goal, you have no idea what you...
And if you didn't hit it, then you at least have an opportunity to try and ask yourself why. What did we do wrong? Mm-hmm. What could we have done differently? If you don't even have that goal, mm-hmm. you're just speculating basically without any information.
But and then on the other hand, right? Let's say you hit the goal. You can look back and say why. Right? Did we increase our processes? Right? Like things are challenging right now. Everyone will say it, right? With prices going up, and it requires a bit of discipline. We talked many times before about pricing matrices. Okay.
Correct.
And not just for this could be any industry, right? Being able to be disciplined with your matrix, right? Like, hey, this price is going up. I need to adapt. I am going to stick to the numbers. Sure. It's going up by this much. That's what it is.
And again, like that the concept of price matrix in and of itself is just a process. Mm-hmm. When you think, it's not like it sounds fancy with the word matrix in there, mm-hmm. But it literally is, hey, here's a process. This is what we're going to charge for this price. And depending on the industry, it could be something like scalable based on, the actual price of the item and what it should be marked up on. But at the end of the day, you're just saying, here's the item. This is what I'm going to charge for it. And when I go outside of that, that means I am not following my process. I'm not being disciplined in what I had originally put in place.
One other thing I want to add, besides being disciplined, and obviously it is very important being able to stick to it, is sticking to your strengths, right? What made your business successful to begin with, right? Because that's what your clients are there for, right?
Sure.
If you said, hey, I specialize in purple widgets, that is my thing. Yes, you can branch out into blue ones. You could branch out into red ones. But when push comes to shove, you should stick to what you've done.
So that's kind of a, there are, I'll say this. I enjoy doing new things that are different than what I've done every day. Mm-hmm. I go to a restaurant. I do not order the same steak every time I go to a restaurant. I actually generally will try to order different things, unless it's a place that I frequent and I've had established my 10 or so things that I like. But it's a little bit when it comes, because you're kind of talking expansion, right? And there's strategic expansion, mm-hmm. and then there's opportunistic expansion, right? So opportunistic is kind of like what you're saying, hey, I normally sell purple widgets, but John down the road, he came up to me and said, hey, if you made blue widgets, I think I'd buy them from you. Mm-hmm. And, we'll just pretend that there is a huge dynamic difference in making purple and blue widgets because, in theory, you're thinking about it and you're like, oh, it's just a can of spray paint or something. Yeah. But you should not then turn around and say, hey, yeah, let's make blue widgets just because John down the road said, hey, I'll buy your blue widgets. Mm-hmm. However, differently, let's pretend John comes to you, and it's actually not that much different to make the blue widgets and the purple widgets, and you do a little research. Mm-hmm. Now you're like, hey, I can make this one tweak, and now I expanded my sales, and now I can sell purple and blue widgets. That is being more strategic about it in a very simple scenario than it would be if you just did it off the cuff.
Right. Henry, as we wrap this up, anything else you want to tell me about, strong versus weak businesses?
Yeah. So, I mean, just some basics for, business owners, like working capital and the working capital calculation, which is literally just your current assets minus your current liabilities on your balance sheet. Again, ask your accountant, CFO, finance manager, whatever job title they have, if you don't understand that calculation. But it's immensely important because you're basically saying, this is all the assets that I could liquidate in a very short amount of time versus all the things that I have to pay in a very short amount of time. If you want me to be explicit, both things are supposed to be 12 months. So when we say very short amount of time, that's 12 months. But it's a good indicator, of your cash health, which, if you're currently running your business off your P&L or whatnot, or you're looking at your bank account, it's not always the best indicator of your cash health, which is ultimately like what we're trying to get to. But it's also, when your bank reaches out to you and says, hey, can you send me all your statements? We got to do the line of credit renewal. That's what they're looking at. They're not looking at just your P&L and saying, oh, this is a profitable business. Mm-hmm. They're also looking at how liquid you are as a business because they want to make sure that you can make those debt payments.
Oh, that makes perfect sense. Awesome. Thank you so much, Henry. You've been listening to Kaizen Time, part of the Blood, Sweat, and Business podcast. If you like what you heard, subscribe and leave a 5-star review. This podcast has been brought to you by Kaizen CPAs Plus Advisors, providing advisory and accounting services to help you grow your business. Learn more at kaizencpas.com or email us at bsb@kaizencpas.com.